The greatest investor in history isn't Warren Buffett. He was a Cold War codebreaker who thought stock tips were superstition and banned Wall Street people from working at his company. His fund returned 66% a year for 3 decades. That's not a good track record. That's the best one that has ever existed. This is the story of what happened when mathematicians took over the stock market. Because they did, quietly. And it nearly broke the world twice. Wall Street versus the mathematicians. Let's run the experiment. Round 1. The invasion. It starts honestly in a casino. In the early 60s, a math professor named Ed Thorpe proved, with actual mathematics, that blackjack could be beaten by counting cards. The casino's response was to ban him, so Thorpe went looking for a bigger casino. He found the stock market. His fund ran for 2 decades without a single losing year. The first quant had proven the point before Wall Street knew there was a point. Then in 1973, 2 economists published an equation that could price an option, a bet on a future price, using pure math. The Black-Scholes formula did something Wall Street's gut instincts never could. It gave a number. Suddenly, an entire market had a manual, and through that door walked the physicists. The Cold War was winding down, academia didn't pay, and banks discovered that people who model rocket trajectories can model prices. Wall Street gave them a nickname that was half insult, quants. The insult did not age well. Verdict: the nerds got a manual. Round 2. The king. Jim Simons was a prize-winning geometer who broke Soviet codes for a living. In 1988, he launched a fund called Medallion, from an office nowhere near Wall Street. His hiring rule was the whole philosophy: scientists only. If you had Wall Street experience, that counted against you. Medallion's machines make between 150 and 300,000 trades a day, each one a tiny statistical edge, repeated until the noise becomes a signal. The result? 66% a year before fees for 30 years. $1,000 in at the start becomes roughly $400 million. In 2008, while the global financial system was on fire and the market lost 40%, Medallion made 80. And here's the strangest part: the fund has been closed to outside money for decades. It works so well they won't sell it. Nobody outside the building knows exactly how it works. That's not a legend, that's the actual situation. Verdict: the math works. Terrifyingly well. Round 3. The warning. Because before you conclude that math always wins, meet the other fund. In 1997, Myron Scholes and Robert Merton won the Nobel Prize for the option pricing math from round 1. They were partners at a hedge fund called Long-Term Capital Management, the smartest room on earth. Banks begged to give them money. Their models said their trades were near certain, so they borrowed. At the peak, roughly $1.25 trillion of exposure stood on about $5 billion of actual capital. Then Russia defaulted on its debt, an event their models rated as effectively impossible. The near-certain trades all failed at once, in the same direction. And because half of Wall Street had copied their trades, the losses weren't contained to one fund. When the model broke, it broke everywhere simultaneously. 9 months after the Nobel ceremony, the fund was dead. And it was so entangled with every major bank that the Federal Reserve had to corral 14 of them into a $3.6 billion rescue to stop a global chain reaction. Verdict: the model is not the world. Round 4. The takeover. LTCM should have been the end of the story. Instead, it was the beginning. Today, somewhere between 60 and 70% of all U.S. stock trading is done by algorithms. The machines compete in microseconds. A human blink lasts 300,000 of them. How serious is that race? In 2010, a company spent $300 million cutting a fiber line straight through mountains from Chicago to New Jersey, 827 miles, to make the signal arrive 3 milliseconds sooner. 3. And the customers lined up because in this market, 3 milliseconds is a superpower. Whatever image you have of traders shouting at screens, that market is mostly gone. And then there's the afternoon that shows what that means. May 6th, 2010, 2:32 p.m. One large automated sell order lands in a nervous market. The algorithms react to each other, reacting to each other. No human is fast enough to even watch it properly. In 36 minutes, the Dow drops 1,000 points, and roughly $1 trillion of value evaporates. Then most of it comes back before dinner, as if the market briefly forgot what things cost. It took regulators 5 months to reconstruct what happened in those 36 minutes. The machines had traded faster than the investigation could read. Verdict: the market is mostly math now. So, who won? The honest scoreboard. The mathematicians won, so completely that the contest is over. The shouting trader is a museum piece. The market you hear about on the news is mostly models trading with models. But the two stories in this video are the same lesson from opposite directions. Simons won by treating his models as fallible. Small bets, thousands of them, never certainty. LTCM died by treating theirs as truth. Math beats gut. Hubris beats math. 66% a year. $1 trillion in 36 minutes. The same equations built both stories. The market didn't get smarter than humans. It got faster than doubt.